Good afternoon. Once again, Market Rebels, it's that time again. Stu, time for
Coach's
Coach's
Corner.
Corner.
Roach's Corner. Coach's
Right,
Corner.
that's
Which
what it was last time.
okay.
Yeah, a lot of people seem to like that, but we have to get back on track with Coach's Corner. And
Okay.
we always try to bring you some pretty cool topics. But you know what, Stu? I think this is going to be an extra cool one
It is
because
an
it's
extra.
something that's somewhat topical for reasons you'll see here in a little bit. But I think I would venture to say that most traders are not aware of how these options are going to get affected in
And
their real life.
that word most includes a lot of people that call themselves professional
Oh,
traders.
yeah, for
Uh,
sure.
I being one of them in my early days when me and a few of the guys in the crowd, this kind of happened,
Hmm.
all sort of looked at each other and said, "Oh my God, what is going on here?" So this is a really cool topic, everyone. Something that you need to pay attention to. It's part of your risk management.
Absolutely. So let's start off as we always do with Chalk Talk, our little thought provoking question. We will answer it at the end of the presentation, but we want you to just think about it for now. So let's say we have stock trading at 100. We look at our broker's platform and we see gamma of 0.10. And now the question is the stock does a 10-for-1 split. So what is your total gamma? And I would imagine that most people are going to say, I have no idea. That's a dangerous place to be. And if you're asking what's gamma, that's an even more dangerous place to be. But what
Yeah.
we're going to explore here is how gamma is affected, kind of a special property or a characteristic, a mathematical kind of a quirk to it in a stock split. So the topic for today, Stu, is stock splits and gamma. Now I
Excellent.
probably should have called it stock splits delta and gamma because gamma is the rate of change of our delta. So if we're going to talk about gamma, we have to talk about delta. But for the most part, the idea is how is gamma affected? What's this special property during a stock split? So let's do a quick review of the Greeks. Five, at least our main Greeks: delta, gamma, theta, vega, and rho. So let's take a look at delta. Delta and gamma are the two that we're really going to focus on for this presentation. So let's say we have IBM 140 call trading for $3. You look at your broker's platform and it says the delta is 60. What does that mean? Well, what it tells us is that if the stock is 140 and if the stock rises $1 right now, we're going to pick up about 60% of that move. So if the stock goes to 141, we're going to pick up 60% of that dollar or 60 cents. We would expect that that option should trade for about 360. Now, you and I know, Stu, that that's really too big of a range, this $1. A lot of traders like to use it because now it just becomes 60 cents that we tack on. But the principle is still the same. If the stock had done, let's say, a 50-cent move, we still take 60% of that, which would be 30 cents. We would expect that this call would trade for 330. All right, so that's really what that delta is telling you. Now, it works in reverse too. So if the stock goes down to 139, if it falls a buck, we would expect to lose 60% of that dollar. We would expect that that call should trade for about 240. Right, that's
Funny
just
how
the
that works, Bill. It's the same way on both sides, huh?
same way on both sides. So again, what's our important caveat here? All things equal, we're assuming that we didn't get a big change in implied volatility, things like that. We're assuming everything else stays the same. We're just going into a pricing model and we're just notching up the stock $1 or some small amount. We should pick up that percentage of delta. Now, of course, that's not going to stay constant, right? Delta is going to change, but we'll talk about that in a little bit. But for right now, it's always about the next dollar move, not every single dollar move. Now, for puts, same idea in reverse. Your put delta is going to be negative, assuming it's a long option. So if we have the 140 put trading for 3, stock's at 140, how does this work? Well, if the stock goes up a buck to 141, what is delta telling us? We have to subtract 40% of that dollar move, or about 40 cents. We would expect that that put would trade for 260. All right, so put options lose money as the stock rises, they gain as the stock falls. So if the stock should fall to 139, what's going to happen? No, we should pick up roughly 40% of that move, or $1. Note, I'm sorry, 40 cents. Notice we take minus 40 times a minus $1 move. Negative times a negative is a positive. That's kind of why they show that as a negative. So we're going to see that option, that put option trading for about 340. All right, so that's just the basics of how delta works. Now, what about gamma? Gamma is related to it. It actually shows the rate of change of delta. So sometimes you'll hear gamma called the delta of the delta. Delta shows us by how much our options price will change. Gamma shows by how much our options delta will change. So let's go back to our stock trading for 100, and let's say the delta is a half or 50. We look at our broker's platform, gamma is 0.05. What this is telling you is that if the stock rises $1 right now, not next week or next month, we're talking about a relatively immediate move, the delta is going to change to what? Remember, it's going to change. Well, that's easy. We take the old delta and we add gamma to it. So the old delta was 50, the gamma is 5. We would expect that our new delta will be 55. And then the process continues. Next stock move, we'll pick up 55 cents. We'll get a new delta. We'll get a new gamma. And that'll be true until the delta gets 1 and the gamma goes to 0. But for the most part, they're always moving. All right, so this is an important part, a little background just on delta and gamma.
Or the delta gets to 0. So quick comment on a couple of those things.
Delta.
So sometimes the negative and the negative to make the positive gets a little confusing for people.
Sure.
I get, and that's the way the broker platforms kind of put it. When you look at it, it looks like a negative delta. Sometimes it's just, I think, easy for people to just kind of remember what delta is, right? I mean, it gets away from like, let me remember the equation, forget about that. It's just, what is it? It's the change in price. It's the, how much is the change in price? And the second one, the gamma, is the, how much is the delta changing? And remember that it's always on the curve, right? It's not going to be constant. It changes as the stock is moving up and down, the delta is changing. And as the delta is changing, the gamma, as it gets further out in the money or out of the money, the delta is changing as well. And it is not like some people think per $1 it changes. It doesn't really work like that. No. But for us, for now, it's close enough to get the idea that it's a per $1 change, just to get the idea.
Yep. So let's continue on with delta gamma. Before we do, please check us out, marketrebellion.com/get started, especially for all of you new traders out there. Get a really good foundation with your options trading here. Lots of great videos and articles to help you get started. marketrebellion.com/get started. So let's take a look at this graphically, Stu. We often teach that there is a bell curve, kind of an implicit bell curve that sits over every single stock price. And as that stock moves up and down, the bell curve moves with it. And if we want to get fancy, as volatility increases, the bell curve gets wider. As time passes, the bell curve gets skinnier. But there's some type of a bell curve sitting over the stock price. So let's say that our strike price is right here equal to the current stock price. It's an at-the-money option. So notice that the right half of the bell curve is blue, left half is white, roughly 50-50. And this is one way to understand roughly what delta is showing us. It is showing that there is roughly a 50% chance for that option to go in the money. But if the stock price rises $1, what happens to that bell curve? It's going to pack its bags and move right along with that stock price. So let's say the stock moves up $1, but remember that our strike stays the same. The strike doesn't change. So this black arrow stays fixed. So watch what happens when that bell curve moves to the right. Black arrow stays fixed. So do you notice how we're not lined up at the center anymore? Right? The center is on the current stock price that's up at maybe 101. But we picked up, therefore, to the right of the strike of the black arrow, this little red strip. And what does that do? That's gamma. It's showing us by how much we increase that blue area. So our new delta is 55. So we would say that gamma, that little red strip, is gamma. That's what it looks like visually. It's just saying by how much are you incrementing or increasing this area under the curve. If the stock rises again, we pick up the green strip. And if it rises again, we pick up the yellow strip. And you can see what's happening. As we move from these gray dotted lines, this is where we were from, and we're moving to the right, you can see that gamma shrinks. The red bar is taller than the green, green is taller than the yellow. And as that stock price moves, we will eventually, what will happen to these bars out here? They're going to be zero. And that's what we said. Those gamma bars will eventually go to zero, in which case the delta is 1. That's saying that the option has moved so far in the money that mathematically speaking, not practically or real world speaking, but according to the bell curve, it really has no shot of falling out of the money. And therefore we say it's delta 1 and behaving like stock.
Yeah. So a couple of things on that. Like Bill said, remember, it doesn't mean it won't or it can't. It just
Right.
means that at that time, it's showing a 1 delta.
That's
And
right.
another way to kind of look at what Bill's doing here is just to say, well, it was kind of right in the middle, right?
Yep.
$50 strike price, the stock is $50. You know, you're not on either side of it. It's really a 50-50 shot. Now that it's, and Bill said that the strike price remains constant. That's really important.
Yep.
A lot of people have a little trouble kind of, you know, picturing that the stock price is actually moving around a fixed point called
That's
the strike price.
That's
And
right.
that option becomes further in the money or further out of the money. And when it does, it's going to pick up delta or it's going to lose delta. It's not really 50-50 anymore. When you bought it, it might have been 50-50. But now that the stock price has moved, it might be 10 points in the money. It might be a 65 or a 70 delta.
Yep.
Things are not the same anymore. And as you're getting closer to that 1 and away from that 50, you have less movement. See, from 50 to 1, you had 50 deltas to go. But now that you're at 70 to get to 1, you have 30 to go. So the gamma, the rate of change, the amount of change that can happen is now shrunk. And that's what Bill is showing here. It's just, it's getting less until eventually it'll get to 1, or the other way, eventually it'll get to 0.
Yep. Or
The delta.
Yep.
And you would have gamma at 0 at that point as well.
Yep. So that's kind of a good visual, a little background on delta and gamma. You can see that they are related. So let's talk about some gamma properties. Now, it turns out mathematically, if we double the stock price, that we are going to cut that gamma in half. All right, so just remember, if you take 2 times the stock price, we now divide gamma by 2 or multiply by half. Yeah. If we take 3 times the stock price, we end up with 1/3 of the gamma, or divide gamma by 3.
And that's a linear equation. Like if it goes from 50 to 100, your gamma went from 30 to 15.
Yep. So we have works in reverse as well. If you take half the stock price, and this is where the stock splits are going to come in, you are going to end up with 2 times the gamma. Your gamma is going to double. Yep. So you can just think of it as though you were going to divide by half or multiply by 2. If we cut the stock price by 1/3, your gamma is going to go up to 3 times. All right, so that's always going to be true. Try that in a pricing model. You see that's always going to be true. So visually, this is what it looks like. If we have a $100 stock, and then we have a $200 stock, and you can see that the $200 stock, the bell curve is shorter and wider. Now, why is that? Well, even though they might have exactly the same volatility and the same time to expiration, a $200 stock can move further than a $100 stock. Same percentages, but in terms of dollars, the $100 stock can only move this width, maximum under the red curve, whereas the $200 stock can move under the gray curve. It just has a bigger range, not necessarily because it's more volatile, but just because it's more expensive.
Yeah, it's not about volatility. It's just a
$200 assuming that's all the same.
$100 stock. Yeah.
Yep. So you can see, in order to have that wider range, what do we have to do in the middle? We got to squash it. And that's one way of visualizing what's happening with gamma. We have this number, we get cut in half. Notice that the top of this gray curve is halfway in that red curve. All right, so that's one way to kind of visually kind of think about what's happening. Now let's go back to the previous slides where we talked about some picking up these little bars of gamma as those red and gray curves move to the right. let's say the stock moves up $2. We picked up the dark blue bar, then we picked up the light blue bar. Question for you, Stu, how big are the blue bars relative to the red? Or if we compare it to the gray, which one has more area?
Well, it looks like the blue one is smaller than the red one.
Well, the blues, well, what I'm saying is that the amount of area under the blue compared to the red is a bigger proportion than the blue compared to the gray.
Oh, I thought you were asking me as it moves to the left. Sorry about that.
Yeah, that's okay. Yeah. So you
Yeah,
can see that, and that's what's showing is that's another way of showing that the gamma just isn't as pronounced because we're still moving the same stock price, but the size of those bars relative to the red is much bigger. In fact, twice as big. All right, so that's kind of a little visual to show what's happening. All right, now with that background, let's talk about stock splits. What in the world is a stock split? Well, before we answer that, again, quick reminder, marketrebellion.com/get started. All kinds of really cool information, just like you learn here each week with Coach's Corner.
And keep in mind what's going on these days, everyone, right? 10-1.
We're seeing
Google,
them.
10-1. That one was 10-1. 5-1 on what was it? Tesla,
actually, Google was 20-1.
Oh, 20-1. That's right. CMG, I think was 50-1. Was 50-1?
Yeah, there's been a few monster ones that we normally
there's
didn't
like
see.
the stock prices have gotten so large over the last few years, and the whole stock split arena kind of went away in the early 2000s and has since come back. Right, we're starting to see a little
bit. I know back when we were trading, it was if you saw a stock hit 100, you knew its days were numbered before a stock split was going to come.
It was going to split 2-for-1, 3-for-1, sometimes 4-1. Right, they wanted to get that price down, but then they kind of let them go.
Yeah, I know it was kind of there were a lot of studies that were done that used to say that a stock tended to perform better if it was in a usually like a $25 or $30 to $60 range, and that's why when they hit 100. It was usually a 2 or a 3-for-1 split, trying to get it back in the $25 or $30 range. But then suddenly it went away, and now you're starting to see them more, which is why we wanted to do this Coach's Corner. So let's take a look at stock splits. Now, there's a couple of different flavors of these. One we call a whole number split, and these will be things like a 2-for-1, 3-for-1, 4-for-1, where that second number is always a 1. That's a dead giveaway that we have a whole number split. Then we have another flavor that is called a fractional split, and this is when you get into really weird things. It might be a 3-for-2, 5-for-4, 8-for-7, but that second number is something other than 1. So we're still increasing the amount of shares just by a much smaller amount.
And they're always a pain in the those fractions.
They're very tough on the options just because these are usually not evenly divisible. So the main thing to understand right now is that a stock split will always decrease the stock price. A reverse stock split will do the opposite, but if it's a regular split, it's going to decrease the stock price. But stock splits always increase your number of shares. Okay, so if you have 100 shares and it does a 2-for-1, trading at 100, it's going to be trading for 50 on the split date, but you will have 200 shares.
Yeah.
Right, so the stock price gets knocked down by some ratio, which we'll talk about, and the number of shares gets bumped up. Now, what are these ratios? Well, there's a real simple way to figure it out. And the key to understanding the splits is that the stock split cannot change the total value of the company.
Wait a minute.
Change the total value of your position.
You just told me I doubled my shares.
Well, but we also cut it in half, cut the value in half. So that would be too good to be true if we could just bump up a company's value by just continually splitting it.
Everything stays the same, everyone.
Everything stays the same. So when it comes to options, the total exercise value cannot change. Little wrinkle in there, but it's the same idea. So the main thing to look at here, I know a lot of people get hyped up on stock splits, but really all that's happening is it's like walking into a bank with a $100 bill and saying, can I get 250s? Yeah, you've got twice as many pieces of paper, but look at the face value, right? It was $100 stock, or each piece of paper had a value of 100, and now they've gotten cut in half. So if you cut it in half, but then multiply the piece of paper by 2, it's still $100. So nothing has really changed. And that's why you really shouldn't get too hyped up at, oh, my stock's about to split. It's there's a mild theory that some people say, well, now it's gotten more accessible to people, maybe in IRAs. They couldn't buy 100 shares at 100, but now they're more likely to do it at 50. I think it's a pretty weak argument, but that's why companies still split stocks. So let's take a look at whole splits. We've got our stock at 100. You own one $100 call trading for 4. And it goes through a 2-for-1 split. So notice that first number, 2. All you're going to do is you're going to take the stock, the current price divided by 2 is 50, just like we saw with the money. And you are now going to own 2 calls at $50. They got cut in half, just like the stockholders. And the option's going to trade for $2. So it's still worth 4. But also notice that the total exercise value has not changed. If you exercised your $100 call, it would cost you 10 grand, right? 100 shares times 100. And if you exercise two $50 calls, it's going to cost you 10 grand. Now, one benefit of the stock split is that it does allow you to maybe only exercise one call for 5,000 instead of 10,000. But in terms of, were you did you benefit somehow from the split? No. Were you unfairly harmed? No. It was just getting 250s for 100. Okay, so that's all that's going to happen. But now let's get into the good stuff. What happens to delta and gamma? So let's put our stock at 100. You own $100 call at 4. Delta is a half or 50. Gamma is 0.10. We go through a 2-for-1 split. What I want you to do, everyone out there, is take 2 divided by 1. The first number divided by the second. It's a nice little trick because it works even if we're dealing with fractional splits. So what's 2 divided by 1? 2. So now what we know, for a 2-for-1 split, you will get 2 times the delta. Whatever your delta was, multiply it by 2. But here's the little wrinkle for gamma. What happens to gamma, Stu?
It goes way up, Bill.
It goes way up, and in fact, by the square.
Yeah.
We have to take our split number 2, square it. We're going to end up with 4 times the gamma. Not
Think of a
2
10-to-1
times.
stock split, everyone. Oh my God, 10 squared is what? 100? Now all of a sudden you got 100 times. It's just tremendous.
Yep. So if we look at our total delta has now gone from 50. We had a position behaving like 50 shares of stock. Now it's behaving like 100.
Yeah.
Now, granted, the stock theoretically can't move as far, but we do have 100 deltas now.
Yeah, that's another story. Just let's do a quick T here. So think about this, everyone. You got one call, it's a 50 delta. How many delta you got? 50 deltas.
50.
Now you got 2 calls. It's still at the money.
Still a 50
It's a
delta.
Delta times 2. Now
Times
it's
2.
100.
You got 100 deltas. But our
The
gamma
delta-
is,
Your delta went up by double.
yep,
and your
but our
gamma
gamma went
Went
up
up.
fourfold, 2 square
Right.
fold. Now, here's the
Here
thing.
too.
You might put this into a platform and say, well, wait a minute, or do a pricing model and say gamma went up 2-fold as well. But what happened? The stock price got cut in half, which, what does that do to gamma? That multiplies it by 2 as well. So we've multiplied by 2 because we cut the stock price in half, and then we
Times 2.
multiply it by 2 again because
got
of this
more.
factor. So gamma goes up 2 squared, or 4. So notice over here we had 10 gamma. Now we've got 40 gamma.
Mm.
And even though, again, theoretically, it should mean that nothing has really changed because the stock's ability to move has been cut in half, what if it doesn't?
Yeah.
What if it doesn't?
It's real life, right? I mean, all else equal is fun for talking about it, but
That's
it's
right.
not that way in real life. I mean, you can have, now all of a sudden you got this giant delta position. I'm sorry, a bigger delta position and
Bigger
a
delta.
giant, gianter, if I could talk like Greg for a minute.
Like Greg,
A gianter gamma position.
Yep.
And all of a sudden your long delta is quickly becoming short delta via gamma.
accelerating exactly.
Really more quickly, quickly than you kind of thought it was going to.
Or
because-
even noticed. Yeah, in the past you said, hey, every time the stock moved up, my option did this. Or if it moved down, you kind of get in the feel or the rhythm of it. And then after the split, you're going, holy smokes, what's going on here?
Yeah.
I'm getting smoked. It must be the market makers. No,
Yeah, it
it's
must be.
because it's because you didn't understand the mechanics of these splits.
Yeah, your delta just kind of flipped on you. You didn't even know it because you weren't paying attention to your gamma.
Yep. Your
Right
slope
now,
has gotten steeper. That's riskier, but
smoke.
the gamma. And you
Yeah.
can make a very strong argument that gamma is a bigger risk of an option. Normally we talk about the slope or delta, but we can also talk about risk as being the volatility or how rapidly a price increases or decreases. And that's what
So,
gamma is showing you. And it
yeah,
just went up fourfold.
yeah.
All right, so now let's do the same thing with fractional splits. Same exercise. Now I changed the stock price to make the math work a little easier, but it's exactly the same math. Let's put the stock at 150. You own one $150 call trading for 4. It goes through a 3-for-2 split. What's the rule here, Stu? Take the first number divided by the second.
One and a
3
half.
divided by 2 is 1.5. That's really saying that you're increasing the number of shares in the float by 1.5 or 50%, or your own position. I had 100 shares. I'm now getting 3 shares for every 2 shares, right? I had 50 groups of 2 shares. I'm getting 3. I've got now got 150 shares. So I had 100. I've got 150. It's an increase of 50%. That's why these fractional shares are going to be less than 2 for 1. They're trying to increase them by 20% or 25% or something smaller, but it's still going to increase the number of shares. So how do we figure out our stock price? We take the stock price divided by the split ratio, right? Divided by 1.5 brings us down to 100. Now you would own $100 call. You used to have the 150 call. It will trade for 266. Nothing has changed. But now we got a little bit of a problem here, Stu.
Hmm.
How are we going to give you 1.5 contracts or 3 contracts for every 2 that you own? What if you don't even own 2?
I think we got to change the deliverable on the contract.
Very good. That's exactly right. What the exchanges do is they say, all right, look, typically when an option is first listed, it controls 100 shares. What they do on a 3-for-2 is they're going to say, let's make it control 150 shares. So you still have one option. And this is where a lot of people think that, I've gotten harmed here because I still have
You're
one
not getting
call.
yeah.
Right. And I actually, that should be up 1.5. That should be trading for 6. Right. So
It gets
that
a little
option.
tricky, because the deliverable changes. But just remember, look, nobody's ripping anybody off. You're not.
That's exactly right.
Nothing is really changing.
No.
But it's weird because it used to be 100, but now it's not 100 anymore. Right now it
Right.
delivers 150 instead of 100, and that's because they have to compensate for the fractional split.
Yeah. And this is a little side note here where a lot of times people who don't understand options, they'll look at maybe a low volatility stock in their account and they'll go, "Oh my gosh, look at this. I can get $8 by selling this covered call." Well, they don't realize it just went through a massive fractional split. It's not really as juicy as it looks. Just like if this one were trading for 6, it's just because it now controls 150 shares. But again, notice that our total exercise value is 15,000 before. If we exercise one call at a 150 strike, that's 15,000. If we exercised one call at a 100 strike, but at a 150 shares deliverable, still 15,000. All right, so it's still 15,000 before and after the split. So again, nothing, you weren't benefited, you weren't harmed, it's just getting change. Now let's take a look at delta and gamma for a fractional split. Stock's at 100, you own the $100 call for 4, delta is a half, gamma's 0.10. 3-for-2 split is what, Stu?
1.5.
1.5. Take 3 divided by 2, and we're home free. 3-for-2 split, my delta goes up by 1.5 times. What happens to my gamma?
Your gamma is going to multiply. It's going to be by the squared. So it's 1.5 squared, which would
Very
be
good, which is 2.25. Just put
Yeah.
that into a calculator. 1.5 squared is 2.25. So your gamma goes up 2.25. So your total delta, right, it was a half, it picks up 50% or 1.5 times, but your gamma goes up to 22.5. So you can see that it was a 10 gamma, it's now 2.25 times bigger. And not a lot, but that's also because it's a fractional split. They're not going to be as severe. But now, I think you kind of even mentioned this before. Think about recently, Supermicro SMCI, September of this year, did a 10-for-1 stock split.
Yes, it did.
And if you're not aware of what's happening, everybody out there in YouTube land, what happened to your delta? Take 10 divided by 1 is 10x. Your delta goes up by a factor of 10.
And
You would have 10 times the delta. That line is now 10 times steeper. So you were on the bunny slope, and now you're on a massive black diamond slope. You've got a
so
lot of deltas.
maybe you had 1,000 delta. Now you got 10,000 delta.
Now you got 10,000. People don't realize that.
100 to 1,000. I mean, it's big. It's a big change.
And what happened to your gamma?
It went up 100. I mean, it's just
100 times greater.
ridiculous.
Okay, so this is where, now again, you could say mathematically the stock doesn't have the ability to move as much because it got cut by a factor of 10.
Yeah.
But what if it did?
What if it did?
What if
Yeah,
we
what
get
if we
something
get
like
that?
this on SMC?
Exactly.
Now you're going, holy smokes, when it was doing all these little gyrations in here, yeah, it was up a few $100, down a few $100. Now it does this, and I'm getting absolutely clocked. Why? Well, it must be because it's such a big drop. Well, that's part of it, but it's because you've got 10 times the delta and 100 times the gamma.
Yeah. Or, Bill, I can also say the other way around, right? Suppose you got this massive gamma position, and now on the way down like this, on this big gap, and on the way down, it's now the gamma is reducing the delta, and now all of a sudden you're short delta, and you don't even know that, and maybe it's trading down there, and then maybe after the earnings tomorrow, it's back up to 50 or something. I don't know. I mean, crazy stuff happens, and
Oh, absolutely.
we're short delta down there, and you didn't even know it because of this huge gamma, and now all of a sudden, like you didn't cover, and it's back up, and it's just a mess.
Yeah. And that's why people go, I don't understand. These options are so risky. It's the market makers. And you're going, well, yes, of course, there's going to be risk in anything in the markets, but you have to understand what you're dealing with. And so that's really what we wanted to show you here. We talked about Google a couple of years ago. I think it was 20 for 1. What happens to your delta there? 20 times.
It's going to be
20 for 1. Take 20 divided by 1. Your deltas go up by a factor of 20. What happens to your gamma? 400 times bigger. And that's because your gammas actually, if you look at them on a pricing model, went up by 20, but because the stock price got cut by 1/20th, it goes up by another factor of 20.
Yeah. And
this
is real life stuff. Just a quick story, early on, way back when we were trading on the floor in the early days of trading back in the 80s, I remember this happened. We had these splits were fairly prevalent. And we had I think we had a 4 for 1, might have been a 5 for 1 split. And, I mentioned this in the beginning, and all of a sudden these Greeks just blew up.
Yep.
We came in the next day and we looked at our sheets, and
what happened?
We were just like, what happened? We thought the clearinghouse made a mistake. and the stock is moving around all over the place, and the P&Ls are out of whack, and nobody knew what was really going on. And we quickly figured it out, but I mean, we're seat holders on membership holders of an exchange, and we didn't even know what was going on. So this is real stuff. This happened. This really does happen. Pay attention to it. And even if you don't feel like going through all the math and what it's going to be and all that, which you should do anyway, pay attention on the split to the new Greeks and see what you have.
Put it into a pricing model. You don't need to understand the math. Just recognize, hey, I remember something weird happens here. Let me go check it out.
Yeah.
Because for those who like to sell these way, way, way out of the money naked puts, what do you suppose would happen if you're selling it for pennies, but you say, let me sell it 50 times, and it does a 20 for 1 split?
Yeah. And then the Vega and all that. Oh, my
And then
God.
the Vega, and then it goes, turns south on you, and not even have to go in the money, and you are beyond buried. So you have to understand this, how these, especially for the gamma, how it works. It goes up by the square of the split. So hopefully that's helpful to everybody. And with that, let's go back to our chalk talk. Stock is 100, gamma is 10. Stock does a 10 for 1 split. What is your new total gamma? You should be able to figure that out. What's gamma? 10. We multiply by 10. It is now 100 times larger.
Yeah.
Yep, 10 squared.
And just
So,
remember, just recognize that it's a big change, and as the risk
if you remember nothing else, right?
you need to know that it is not what it was. Let me see what it is or what I
Right.
think it might be, and then proceed accordingly. And if
Yep,
it's
put it into
too
a
big,
pricing model. Okay, I've got a new gamma of here, and now how many contracts do I have? Multiply them out, and you go, holy
yeah.
smokes! Look, it's up 100
And you
times.
can make these adjustments prior to the split, after the split, right? If it's going to be too big for you and you're not
Do it
comfortable with
before the split,
it,
right?
prior to the split, right?
Take
If
care
you
of the
come into
risk
the split,
before
and
it
you have
manages you.
yeah, exactly, right. After the split, take a look at it in the morning. Hey, I don't feel comfortable with this. Fix it. Just fix it. Get it to a spot where you can feel comfortable managing whatever it is that you have.
Absolutely. Well said. So I think that's probably a pretty good stopping point. Again, I hope it helped everybody out there in YouTube land, all of our Q&A people and some of our new people out there in YouTube. But make sure that if you're going to venture into options trading, especially if you're new, make sure you get good training because there's a lot of bad information out there. And even as this little presentation showed, it can get a little tricky. And if you're given bad information, it only takes one bad trade to wipe out everything. So if you would like to take your options trading to the next level, give us a call. You can talk to somebody like Stu or Scotty and get coached the right way. And with that, I want to thank all of you for being here. And we will see you next Thursday, 4 p.m. Eastern, on our next edition of Coach's
Yep.
Corner. We'll see you then.
See ya. Take care.